looks like there's tremendous stress in credit. There's stress in credit. Well, Puerto Rico is an example. There is stress behind the scenes in credit, and if you look at the credit needs to be serviced by the real economy. And the real economy, all over the world, I mean, a global phenomena is the global economies are not growing. They're actually shrinking. I mean, just look at the retail numbers we've gotten from individual retailers just in the last week.
Yeah, I agree with you on that. The real economy is collapsing. There's actually mountains of evidence proving this, whether it's container ships or ghost trains in China or so many other examples of restaurants and retail stores closing. There's also the record amount of oil jobs. I don't know, do you still live in the Texas area? There's been a record amount of oil jobs lost as well in this oil bust.
Yeah, we're in Texas. As a matter of fact, I was just on Galveston and talking to some oil people, and they're telling me it's just devastating. It's unlike anything they've seen in previous busts.
Now that Jim Sinclair, Bill, has asked people to join his class action lawsuit against Deutsche Bank for their role in manipulating gold and silver, are more investors who have lost lots of money since 2011 and mining companies interested in joining the suit from what you hear?
To clarify, this original suit is for producers only. It's for mining companies only. There will be add-on suits later where individuals will be asked to join. But yes, there is interest amongst mining firms to join the suit, and it's in the works.
That's very interesting because, like, over the years, I've talked off the record with a number of mining companies looking for investments. I ask management pretty poignant questions looking for opportunities. And, off the record, some of them will admit that gold and silver are manipulated, but they don't want to go on a podcast interview, on a recording. They don't want to go on, BNN or Bloomberg or anything like that and admit gold and silver are manipulated. So you're saying now that this evidence has come out, that Deutsche Bank has admitted, you're saying that they're finally starting to be less apprehensive then of coming forward?
Well, in the past, mining companies didn't want to do anything because they were afraid of losing financing. They were afraid of losing permits, etc. Here you have an instance where Deutsche Bank has actually admitted guilt. So in any suit, guilt does not have to be proven. We also know that they're going to name other co-conspirators. They're going to turn state's evidence. So this is no longer conspiracy theory. This is conspiracy fact.
Yeah, that's a good point. And there's a lot of crazy things going on in the global economy. One of them is this 28 pages of 9/11 report, and the Saudis recently threatened the U.S. government with dumping all their U.S. treasuries if that report was released, and I think there's other reasons for this. What would happen to the global financial system and the U.S. economy if the Saudis did decide to actually dump lots of those treasuries onto the market?
I've talked about this in the past. The $750 billion is not a problem. I mean, they could dump that or even arrange with the Fed to buy that, and you wouldn't see anything happen to interest rates. You'd see nothing happen to the bond market. The trade would go through. But then you've got to go a couple steps further forward, and one step would say that oil revenue is no longer going to be recycled into U.S. treasuries. So that brings up the Fed would basically be the only, they wouldn't be the buyer of last resort, they'd be the only buyer. And that would more or less confirm that the Fed is outright monetizing the debt. And going even one step further, I mean, once it's understood that they're monetizing the debt, you got to look at the U.S. dollar index, the dollar versus foreign currencies. The Fed can buy treasuries, but they can't buy dollars with dollars. And if you think this through, the reason they can't buy dollars with dollars is because it's like trading the same color marbles. And the only way to entice somebody to swap the same colored marbles would be if somebody swapped 10 marbles for your 11 marbles. And in doing that, you're basically discounting it. And the world would understand that in order for the Fed to be buying dollars, they've got to be creating dollars. And that basically dilutes the dollars outstanding.
Yeah, that's interesting, and that's also why I think we're seeing a lot of these other countries, especially the ones with sovereign wealth funds, a lot of these oil-producing countries, they've started selling a lot of their stock positions. They've gone to cash. Over the last couple decades, though, they've been buying a lot of assets in the U.S., but their own economies have been doing so poorly with the low oil prices and low commodity prices the last couple years. They have to bring that cash home. They have to liquidate assets to protect their own economies. Is that what you're also seeing?
Right, of course. It's that goes back to what we talked about earlier about the real economy shrinking. As the real economy shrinks, they're going to have to sell off financial assets to try to support their programs.
Now, Bill, I want to ask you about the gold and silver market. You've written about the spike in futures contracts, open interest on COMEX. Why do you think they're spiking so quickly? Is this an attempt to, knock the price back down? Is this part of a managed retreat strategy? What's your gut telling you about this?
I think that's just plain common sense. I mean, they've added 100,000 COMEX contracts in just 2 or 3 weeks, or even less time. That's like 10 million ounces of gold. That's over maybe 12, 13% of global production has been added in open interest. And basically what that is when people are stepping up to buy the gold contracts, they're just opening new contracts so it doesn't push the price is not really being pushed higher because they're diluting the value of the contracts by opening new contracts. It's a way, it's like, and I've said this for years, it's like what the ETFs did. My personal opinion is that you put money into some of these ETFs and they don't buy the gold. So what happens? You thought you were buying gold, and if billions and billions of dollars went into the ETF but they didn't buy gold, it did not push the price higher. And the reason being because the paper acted as a pressure release valve. It relieves the pressure, the upward pressure of the demand.
Yeah, I've heard it called fractional reserve bullion banking before, where you think you're getting the metal, but you're really just getting paper exposure. So if you actually want the metal, you're not really getting it. Although, a lot of these hedge funds that are doing trend trading, I don't think they care about the metal too much. They just want exposure to the trend.
Right, that's correct. You do have the momentum traders, and they're not looking for the metal. But the paper does act as a diversion away from real metal.
Yeah, I would agree with that. And I think it slows down the demand growth for the actual metal. So people are putting all their capital into paper, and then the underlying, the ETFs, like you mentioned, or other instruments or the futures exchanges don't have to go out and get the metal then, or they can promise to deliver it, 6 months or a year later and call it not a default because of their lawyers and how the contracts are written.
Right, exactly.
Now, Bill, I want to ask you about the oil rally in base metals. Do you think there was any fundamental reasons for the rally in oil and base metal prices, or were the large investment banks involved in some type of manipulation so these prices could go temporarily higher, so these banks didn't have to, default on their massive oil loan books, oil and energy loan books, and base metal loan books, and things like that?
Yeah, if you look at these rallies, real world, what they would be saying is that the real economy 6 to 9 months is going to pick up, and there's going to be more use of the base metals, oil, etc. And I don't see that. I think what you mentioned at the end, where these big commercial banks are facing some pretty big hits as far as defaults on loans, it may very well have been done to try to prevent the loan books from being beaten up.
Yeah, I actually spoke to one of my sources in the oil market. He's been in different jobs in the oil market for over 30 years, and he actually said there was Saudi and other OPEC sovereign wealth funds, and they were actually, about 2 years ago, they started shorting the oil market, hoping to bankrupt a lot of these shale oil producers. But a lot of these shale producers haven't gone bankrupt yet. I mean, there's been some, but a lot of them are still pumping, even through bankruptcy, some of them. So it's been a really crazy market in the oil market with a lot of games behind the scenes. It's not a it's not a free market. There's just a lot of manipulation and gamesmanship by either Wall Street providing, these shale oil companies with ridiculous amounts of credit backed by the Federal Reserve, or you have the Saudis on the other hand trying to manipulate the market lower because they're one of the lowest cost producers trying to bankrupt the higher cost ones.
Yeah, my thought process is this was originally done right out of Ronald Reagan's playbook from the 1980s to try to, when he busted the USSR. I think originally this probably was put together in Washington to try to bust Russia and bust Putin. And I think it's backfired because they're not a leveraged country or company. Has it hurt their cash flow? Yes, it has, but it's not gotten the desired result. And then I think what happened was that oil market was so highly leveraged that a pullback to the 60 or 70 level, which I think is what the design was, turned into an all-out rout because you had a complete wipeout, a forced margin call of the industry. And that's why you got oil down into the 20s.
Yeah, and once it broke those support levels at 60 or 70, like you said, the trend traders could just draw a straight line down on the charts with the support levels being broken down, and they could say, you know what, this thing's going to 50, this thing's going to 40, and that's what we heard on CNBC and Bloomberg was, every time it would go $5 or $10 lower, the people would just say, oh, it's guaranteed to go another $5 or $10 lower. So it was turned into a full-on rout, like you said.
Well, and I can tell you, just from first-hand experience, here in Texas, you can see that the oil working population is decimated. I mean, there are layoffs of 25%, 50%, 70%. Just look at the oil rig count. I mean, I can tell you 3 years ago, we would see all type of oil field equipment going up and down the road every single day. And I'll bet you it's been, in the last month, I might have seen one set of oil trucks, and I would, on a daily basis, see 4 or 5 or more sets of oil equipment being hauled up and down the road. So it's definitely, I mean, there's no doubt about it. It has definitely affected the oil industry.
Yeah, and I think long term, this bust here is going to be good for oil prices unless, Elon Musk and his kind of crony capitalism at Tesla. Tesla makes a beautiful car, but he's also getting all these, subsidized government loans to build out the gigafactories and stuff like that. I still don't think he's made a profit on any of his cars, and Tesla's been open a long time.
There's been not $1 earned, and I mean he's selling cars for well below what the total all-in cost is.
Yeah, so maybe that's the plan from the central planners then to use all this free credit that they can create to get people to switch to these cheaper electric cars and wean people off of oil. But I mean, if the market was a free market, he would have to make a profit to stay in business, and that doesn't seem to be the case.
Yeah, there's no telling what the plan is. I mean, it's and I've said this for years and years that, and I'm talking from a U.S.-centric view now. There's no doubt in my mind that there's got to be some type of plan or planned destruction of the U.S. because no one could be so stupid as to put into place the policies we have in place now.
That's an interesting theory. Yeah, I mean, the middle class in America has been decimated for decades with inflation and taxation. Obviously, the inflation part has been hidden, but the taxes, it just seems to me, you live in Texas, there are a little bit lower taxes than most other states. But, it just seems like there's new taxes layered on each and every year. You add to that now that Wall Street, there was a secret meeting recently, and the large Wall Street banks are testing now an all-digital currency that is backed by blockchain technology. Do you think this is part of a larger plan then?
Well, I have no doubt that over the next 10 or 20 years that we're going to go to a digital currency. So, yeah, I think that, we're on the doorstep of something like that. One comment on what we were just talking about. One other group that's been decimated are retirees, because interest rates are zero. So they've worked their whole life, and now they're having to spend principal as opposed to living off of interest.
Yeah, That's a great point, and it's not just the U.S. doing that. You got Japan doing that. You got Europe doing that. China's now even in the financial repression game. This seems to be like one of the end goals of Keynesian economics here. They've reduced, the interest rates down to zero in most cases. They're going negative, and they're trying to force people to spend the money instead of saving money. When in reality, we need the exact opposite. To have capitalism, to have a prosperous economy, you have to have savings. You have to consume from capital rather than using debt to consume and build things.
Right, and the money itself needs to be real. I mean, that's the root of it all. Is that the money itself is fake.
Yeah, I completely agree with that. And then they're planning a digital currency so they can stop all cash economy. This looks to me to be part of this cashless society plan, this digital currency, so they can track and tax every transaction. So if you were getting paid, if you were part of the underground economy maybe and you were getting paid in cash off the books, that's going to stop then if they ban cash and they force everyone into the digital currency, then their tax, they can take their tax cut immediately.
That's all correct.
Well, in terms of your collapse scenario, you've talked about this in the past. Do you think we're more likely to have hyperinflation, really bad worsening stagflation, maybe deflation first, or is this going to lead to some type of martial law and full totalitarian government where they basically can just do whatever they want and most people like you and me aren't even able to stop them?
That's a lot of questions all in one, but I think we're experiencing deflation right now. You're seeing a big tug of war between the central banks trying to reflate and the fact that that there's too much credit in the system are the forces of deflation. And it's my opinion that you're going to see something snap somewhere in the derivatives chain that'll snap all derivatives. And basically because fiat currencies are credit, the fiat currencies are going to implode. And some people would say, oh, well, the Harry Dents of the world would say, well, that's a deflationary scenario. But it really isn't. It's a hyperinflationary scenario because the currencies themselves get wiped out, including the U.S. dollar. So to answer your question, I think we will end up with a hyperinflation. And it'll be caused by some type of derivatives event that'll probably take place over a 2-day period of time. You'll go to bed one night and the next morning something really bad will have happened, and within 2 days your ATM's not going to work, your credit cards aren't going to work, nothing's going to work. And that'll be the result of a derivatives train wreck.
There's already hyperinflation in, really screwed up countries with really wacky governments like Venezuela and Zimbabwe and things like that. But a lot of Americans thought that could never happen here. But I agree with you about Harry Dent. I mean, some of his predictions the last couple decades are just been ridiculous. Obviously, he's gotten a few predictions right, or he wouldn't be able to sell any newsletters and things like that. But the majority of his predictions have just been totally ridiculous. I mean, he's going to be screaming deflation this and deflation that while gold keeps going higher and higher, and more Wall Street money like Stanley Druckenmiller and so many other more astute money managers who I think have a better track record are, selling out of other asset classes and putting their money into physical gold.
Well, all you need is one big money manager to step up to COMEX and say, deliver $1 billion worth of gold, and their gold is gone. So whether you want to call that a default or not, actually the way it stands right now, if you go back over the last 3 or 4 months, there's actually more contracts. It looks like more contracts standing for delivery. There's about 20 tons, 21 tons or something like that. I think they've got 18 tons in the registered category. So it already looks like they're not making or able to make full deliveries, and the fact that the open interest during delivery months declines, these people who stand for delivery have to have 100% cash to make the settlement in their account. So who in their right mind is going to put the full amount of money to settle the contract and then go away? It doesn't make any sense unless they're being offered a premium not to take the metal. And that's what I believe has been happening, is that standing contracts have been offered premiums to make settlement and to go away and not take the metal.
Yeah, Zero Hedge reported that happened in 2010 and 2011, especially in silver, where people were paid huge cash premiums to walk away from taking delivery. It was only a matter of time that we were going to have that again with, when the gold and silver prices got extremely low, when in U.S. dollar terms, gold got to 10.75, silver got to around 13. Those were prices where the miners, the primary gold and silver miners, were going to struggle to maintain supply. They were thinking of shutting down mines. So we were at a level up there. I think we've gotten to almost a perfect storm scenario in silver where there was supply problems in the physical silver market due to base metal miners not being able to cut back on their production. The demand for silver was strong, and then the U.S. dollar index started to weaken.
Right. It's going to be the perfect storm. I mean, it is the perfect storm right now, and it's just a matter of time that physical demand overwhelms the paper supply.
Now, I want to ask you about the China fix on the Shanghai Gold Exchange, and also about this piece that Turd Ferguson published called Paul Milcreast wrote it, but Turd Ferguson put it on his website, called The Death of the Gold Market. Do you think the exchanges and the main exchanges like the LBMA and the COMEX, do you think they're slowly dying now, as this article tends to indicate?
Yeah, and what will happen, I think, is that margin requirements will be ratcheted higher and higher until they go to 100%. And forcing COMEX, forcing LBMA to become physical exchanges. And because their inventories are so small, they'll be relegated to unimportance.
That's very interesting. And then I guess a lot of the business then for a lot of gold contracts would go to China because people would not be as comfortable with all the games that's been played on the exchanges, whereas I think the Shanghai Gold Exchange is a lot more of a physical exchange. There's not as much paper futures contracts on there anyway. There's not the kind of leverage there are on the London Exchange and COMEX.
Right, and that was part of the plan to opening the exchange in the first place, to try to open a cash exchange that makes it more of a real price discovery.
Yeah, I agree. Now, I think in the short term, the gold and silver miners, they've had incredible spikes in share prices, and I don't think it's sustainable where every 3 to 4 months, Bill, we're going to be getting 100% returns on some of our gold stocks. But, on dips, I think the bull market is back in gold and silver miners, and I'm really excited to see how they do the next few years.
Well, yeah, anything that doubles in value is in a bull market. I mean, that's obvious. I would caution what you're saying. You're saying that it's unsustainable and, in another 3 or 4 months you can't have a double. I've written that this is the bull market that you never sell. And you don't sell out of this bull market for one reason. Because when you sell, you're putting your money back into the system that you got out of in the first place. In other words, you're going to be accepting dollars or euro or yen or whatever. Until we have a currency event and some type of new currency comes forth that is believable or can be trusted, you can't sell your metals positions. If we have a 10 or 20% pullback or even a 30% pullback, you can't panic and get out. That's one way to look at it. Another way to look at it is when derivatives do snap, the only thing standing is going to be, in terms of money, is going to be gold and silver. So who's the biggest winner? The biggest winner will be the producers of gold and silver.
Yes. Well, Bill, what I was just saying, though, was that, I'm seeing message board posts and comments from people that, the mining stocks have gone up. Every single time the mining stocks go up higher in price, people just get on board and they chase the price higher, which as a, investor is not good. It's smarter to buy on a pullback. So, if you don't have a position, maybe you should have a position. But there's people there that we're just seeing for people have gone from, being very fearful of having any gold stocks or silver stocks when they should have been, buying them on weakness, buying the companies with the best balance sheets, etc. Now people are getting really greedy to the point where, gold stocks are going up. People are buying and chasing the share price higher and buying even more on updates. So I think that's in the short term, maybe it's a little dangerous for most people unless like you have actually with high frequency trading computers now, it's probably dangerous to put stops in because they'll blow out your stops.
Well, I'll stick to my guns and just say this is the rally you don't sell. You don't sell it until we have new currencies.
Okay, fair enough. Well, Bill, I just want to thank you